Okay, let's unpack this. We're always looking for asset classes with, some kind of asymmetric, performance scarce, high yielding, and honestly, hidden right in plain sight.
Exactly, even though they sit on some of the world's most prime real estate.
Right. So today, our mission is a deep dive into an asset class that is not your traditional luxury waterfront condo.
Hmm.
It's the sophisticated revenue-generating infrastructure that makes that whole ecosystem work.
And that's a really crucial distinction to make. We are zeroing in on what we call blue economy properties. So
Hmm.
we're not talking about just, a nice view from a balcony.
No.
We're talking about cash flow machines. Things like marinas, essential small commercial ports, and those integrated mixed-use waterfront developments that operate around them.
So the revenue comes from services, basically.
Maritime services, storage, and all the associated trade and tourism. It's an operating business.
That is the core difference. It's infrastructure that generates continuous cash flow, and often it doesn't really matter what the housing market is doing. So here's the question we have to answer for you, the listener. Why do these specialized water-based assets consistently deliver better yields and, frankly, better capital preservation than traditional commercial real estate?
Hmm.
Like an office park or a retail strip.
The answer really starts, and I think it also ends, with structural scarcity. And that's coupled with what is basically non-disruptible demand.
Okay.
If you look at the raw performance data we pulled from the sources, it's pretty compelling right off the bat. Well-located marinas across Europe and the Med are delivering net operating yields between, say, 7 and 12% right now.
7 to 12%. I mean, the current global landscape where you're maybe getting 4% on government debt, a 7 to 12% return on a hard asset is, well, it's significant.
It is.
But what are the risks? Is that yield just compensating for something we're not seeing, or is it really signaling the market's belief in the longevity of these cash flows?
It's overwhelmingly the latter. The market is pricing in the absolute permanence of that scarcity. You just have to look at occupancy.
Yeah.
Many of these top-tier assets, they boast utilization rates above 95%. And it's not just that they're full today.
Right, it's the future demand.
It's the future. Many of these places have waiting lists that stretch for years, sometimes for decades, for the prime berths. You just can't say that about almost any other physical asset class.
No, you can't.
The supply is basically fixed and the demand is continuous.
That fixed supply, it just throws traditional real estate analysis out the window, doesn't it? I mean, CRE is always exposed to some new risk office space to remote work, retail to e-commerce.
Right.
But the demand for boat storage, it seems completely resilient. And that's because it's a direct proxy for global high net worth wealth, isn't it? You can't digitize a boat slip.
That's the clean investment thesis right there. Our data shows the global ultra-high net worth population went up 4.2% in 2024 alone.
Just last year.
Just last year. And critically, ownership of these luxury maritime assets grew even faster among that group. And this isn't just about, passive storage. It's about maintenance, fuel, concierge services, security.
All the high margin add-ons.
Exactly. As long as global wealth continues to concentrate, the demand for high-quality, secure places to keep those assets is, well, it's guaranteed to climb.
It's a beautifully simple, wealth-driven driver. But you also mentioned trade and maritime services. So it's not just leisure driving this, right? There are also some massive commercial tailwinds.
Absolutely. The first major tailwind is just the sheer scale of the luxury maritime market. The super-yacht sector, it's not a small niche anymore. It's a colossal 40 billion annual industry now.
40 billion. And that growth must create some very specific infrastructure needs. Explain that. Why does a market that big concentrate its revenue in just a handful of ports?
Because super yachts, they need very specific things. Deep drafts, massive cranes for haul-outs, specialized maintenance crews, and secure, oversized berths.
Things most marinas just don't have.
Most historic, smaller marinas simply cannot handle a vessel of that scale. So this means the few facilities that can handle an 80-meter-plus yacht become these sort of localized choke points.
And they can charge a premium.
A huge premium. They capture disproportionate revenue from lucrative repair and refit contracts that can cost millions of euros for a single job.
So it's not just about the docking fees. It's about capturing that high-margin industrial service revenue that surrounds the whole asset.
Exactly. And then you layer in the trade component. Rising sea freight demand is boosting activity at these smaller feeder ports, especially in crowded coastal areas where, road transport is just inefficient.
So investors are building these layered revenue streams.
Yes, through mixed-use projects. They're combining the core marina with, say, residential, some high-end hospitality, and food and beverage components.
That layered approach must de-risk the asset significantly if tourism slows down a bit
The long-term berth rentals and trade keep the lights on.
and if the local economy takes a dip.
The high net worth and global shipping revenue stabilizes the whole thing. The resilience is sort of engineered into the model.
It is, which brings us right back to scarcity. If the yields are this strong and the demand is this robust, surely capital is trying to rush in. So what is it specifically that stops competitors from just building new marinas everywhere? This is the heart of that natural moat idea.
The moats, they aren't financial, they are purely structural and regulatory. And in many prime jurisdictions, they're nearly insurmountable.
Insurmountable. So let's detail those hurdles. Is it just that it's a pain to get a permit, or is it something deeper?
Oh, it's much deeper than bureaucracy, though that's part of it. The primary hurdles are environmental permits and coastal zone restrictions. In virtually every developed coastal region, getting permission to dredge or to build breakwaters or put any new infrastructure into a protected marine ecosystem is a multi-year process, often a multi-decade process.
So you have impact studies.
Massive impact studies, and then that's usually followed by intense community opposition. NIMBYism. Not in my backyard. Nobody wants a massive construction project on their coastline.
So an investor isn't just buying concrete and steel. They're buying an asset that's already captured this irreplaceable regulatory value, the approvals, the zoning, the water rights.
Precisely. That process alone can take 10 to 15 years and cost tens of millions before you even put a spade in the ground. You're buying an asset that's protected by geography, by government law, and by social resistance.
That structural scarcity is why they have such high pricing power.
And why their cash flow is so incredibly secure.
Okay, so we've established the stable demand and the protected supply. But historically, these assets, even with great cash flow, they were notoriously illiquid. They were generational holdings, right, for sovereign wealth funds or huge PE groups.
With 50-year time horizons, yes.
But this is where modern finance comes in. It's making this asset class accessible to a much broader pool of capital family offices, private banks.
That illiquidity was always the primary drawback, but it is being solved now through specialized structuring. We're seeing huge advancements in fractional ownership and, crucially, in enhancing liquidity.
Let's dive into that example from the sources, the tokenization of the Adriatic Coast Marina. This seems to perfectly illustrate how technology is bridging that gap between a stable physical asset and modern financial fluidity.
It does. It's a perfect case study. We're talking about a prime 180 berth marina. Its ownership was digitized using blockchain. It was tokenized.
Meaning it was split into thousands of fractional transferable digital shares.
Exactly. And this asset raised $28 million in capital in less than 6 weeks.
From investors all over the world.
From 14 different countries.
Raising capital that fast and that globally for a physical infrastructure asset is, well, it's unprecedented. What was the key innovation that made investors so comfortable with that structure?
The innovation was really twofold. First, the fractionalization made a big, inaccessible asset manageable for smaller investors. But the real game changer was the settlement layer. This structure used a fully allocated digital gold settlement layer.
Okay, why digital gold specifically? Why not settle in, say, a traditional stablecoin or even a crypto?
Stability and trust.
No.
Private banks and family offices, they need confidence that the underlying security isn't subject to the volatility you see in crypto markets.
Right.
So by using a digital gold layer, which has a stable, allocated physical backing, they marry the security of a centuries-old store of value with the efficiency of a blockchain.
So you get instant liquidity for your shares.
Instant global liquidity. It enables decentralized ownership, all while the physical asset just keeps on delivering stable quarterly cash distributions in fiat currency.
That is the ultimate synthesis, isn't it? You get the stability, the tangible value of a hard asset, plus the instant global trading capability of the technology. For a wealth manager, that means they can rebalance their exposure without waiting 6 months for a real estate closing.
It dramatically reduces the exit risk. It just fundamentally changes the risk-reward profile for investors who are looking for inflation-protected yield.
Okay, so let's get down to brass tacks. For investors looking to get into this space, you can't just go browse Zillow for a 95% occupied marina. This takes specialized knowledge.
Absolutely. Success in this niche means you have to be embedded in the local legal and permitting environment. It's all about tracking privatization pipelines, seeing which jurisdictions are actually making it easier to invest.
And what are those jurisdictional differences right now? Where are the high-grade opportunities being created?
There are three clear geographical trends. First, you have Croatia. They've standardized offering 50-year concessions, which gives investors the time horizon they need to upgrade the asset and see real appreciation.
And second,
Second, Greece is actively streamlining its large-scale marina privatization program. They're moving state-held assets into private hands, often as portfolio deals, not just one-offs.
the Greek deals sound like an opportunity for real scale.
They are. And third, certain Caribbean jurisdictions. They offer these powerful, tax-efficient holding structures, and they're often paired with government incentives, sometimes even citizenship by investment pathways for very large capital commitments.
Fascinating. So it's a geopolitical hunt. You're combining regulatory favorability with a prime physical location. But once you've identified an asset, how do the serious investors assess its true quality? What are the key metrics?
Well, they look past the generalized numbers and get into granular efficiency. The first core metric is berth occupancy, but it has to be carefully adjusted for seasonal weighting. You need to know the full 12-month revenue cycle, not just the summer peak.
Right, makes sense. What's the second specialized metric?
The second is revenue per linear meter of quay, or RPNLM. We use linear meters because a boat size, its turning radius, that determines the value of that water space much more accurately than, say, the total acreage of the property.
It's the truest measure of the docking infrastructure's efficiency.
Exactly. And the third.
The third.
Third metric is the ratio of dry stack to wet berths. A dry stack facility is basically a high-tech indoor storage garage for boats.
And a higher ratio that signals premium pricing power. Why is that?
Because dry stack facilities, they reduce insurance costs for boat owners. They require less of that ultra-prime waterfront space, which means higher revenue density per acre. And they offer a superior year-round service that's less dependent on the weather.
So you can maximize revenue from both sides of the asset.
You can.
So if a marina scores highly on those three metrics, good seasonal occupancy, strong RPNLM, and a healthy dry stack ratio, then what kind of valuation multiples are we seeing?
These top-tier properties, they routinely trade at about 8 to 11 times EBITDA. Now, here is the crucial insight that ties back to everything we've said about scarcity.
Okay.
That valuation multiple is still strikingly inexpensive compared to the replacement cost. Our sources indicate that the cost to build a single modern berth in a prime location can now exceed €2 million.
Wow. Let's just let that sink in for a second. It cost €2 million to build the capacity for one boat, yet the existing stabilized asset with its permits and waiting lists is trading at a modest 8 to 11 times its current cash flow. That is an enormous intrinsic value gap.
It's the ultimate security buffer. The cost barrier plus the regulatory moat, it secures the future cash flow for the owners and makes the whole asset class remarkably defensive against inflation and any new competition.
This has been a really comprehensive deep dive. I think the key takeaway for you, the listener, is that the value here is synthesized from two really powerful forces. Stable, wealth-driven demand combined with structurally scarce, regulation-protected supply.
And we have to emphasize the role of financial innovation in all this. That stability of the physical asset, when you combine it with the newfound liquidity from things like tokenization and digital gold settlements, it fundamentally changes the profile of this infrastructure from a slow generational holding into a dynamically tradable asset.
So here is a final provocative thought for you to consider as you wrap up this deep dive. Given that these prime properties often trade at 8 to 11x EBITDA, yet the replacement costs are now routinely exceeding $2 million per berth, how long can this dramatic gap between current market valuation and the soaring cost of new supply actually persist before it triggers major consolidation across the global portfolio or forces a massive capital shift toward the handful of existing operators? That gap is where the value truly lies.